All right, I think that we are live. First of all, I hope that you can hear me well. I'm live streaming for the first time, so let's make sure that that works fine. So if you can send me a short message in the chat that everything works fine, then that would be great. For the rest, I don't know, let's see how this goes. I mean, I don't have really experience when it comes to live streams. I have been a guest on a few, but that is a lot different as, if I run out of topics to discuss. Thank you, Rowan. Thank you for confirming. If I run out of topics to discuss, there's always somebody else that I can ask questions to. So as such, it's going to be a bit different. Now, I don't have really a structure, at least not at this moment. I have a couple of news and some interesting tweets that are interesting at least from the last week. So I'll go through that, but I'll keep an eye on the chat. So if any of you has a question, comment, or whatever that may be, I'll make sure to address that as well. Good. All right. Everything is set up properly. So first of all, iRobot, I think this is an interesting one that I think I missed. Interestingly enough, I did follow the company for a very long time, and this was something that I should have covered maybe a couple of weeks ago again. I don't know how many of you have heard of it, of this tiny vacuum cleaning robot company that was acquired by Amazon. At least there was a deal quite some time ago, and as time went by, of course, it's subject to various approvals. The price kept going down because it was basically the acquisition deal price was being revised as iRobot was not profitable, and basically they needed to get more in the form of debt to survive, to keep on going. So of course the enterprise value at that time was different than at the time when the deal was struck. So Amazon was offering lower and lower prices, and there was some uncertainty, I guess, until when this price will go down, the acquisition price. And now they have some approvals moving forward, so it's more and more likely that the deal will go through. And of course, it's not that there's any significant change to Amazon. I mean, iRobot is a very, very tiny company compared to Amazon. So, but yeah, shares are up now 39% because there will be an EU approval. So an interesting event. I'm not really following the Spirit JetBlue merger, but maybe that is something that I can look into. Those are also not very large companies as well. I mean, the mergers are slightly different. There's, of course, there are a lot of conversations that happen around that, but it's a bit of a different kind of events. I think the most difficult part when it comes to mergers is really, are there going to be the synergies that are planned? If you think about it, when two companies merge, regardless of their size, they're trying to continue performing the same tasks as they did before. However, they'll try to merge certain functions. Like, for example, I don't know, if there are 20 people when it comes to their HR departments, they're going to merge, and maybe they get down to 15 or maybe 25 people, depending on the size. And if they can achieve that, then of course they have lower costs. If they don't get to achieve that, then obviously it's not going to be as good as expected. I cannot fully read it. Oh, so what are the thoughts on Bolt allocator? It's difficult. I mean, I'm not really a specialist when it comes to that. I tried to. Let me move this a bit. I'm trying to read the chat as well, but for some reason it's. All right, there we go. I'm not really focused on bonds solely because, of course, they're highly dependent on the interest rates, and that can change in the short term depending on what's going on in the world. We saw that, of course, now recently, the inflation as well, and COVID-19 before, and who knows what will happen next. I personally, I'm more focused on long-term investing, so I spend more time looking into companies to understand the way that they operate and to understand which way they're moving, and there's, I think, a bit less uncertainty if I really do my job well. If not, then of course, compared to bonds at least, I think that there's a lot more that can happen that's outside of my control, or at least that I could see. Oh, there are a lot of companies on my watch list. Probably it's like close to 100 now. I think what keeps me from buying most is the valuation. So there are a lot of really interesting companies. Um, Maybe I'll make a separate video on that because that's probably going to be a very, very long list to go through. Hey Scott, thank you for joining. Yeah, I agree. I think that honestly, I think that iRobot got a very, very good deal. If I take a look at the valuation, it's slightly over 1 billion, and of course, the risk is always that there will be Chinese companies that are able to produce similar products, such as the robots at a lower price. But I mean that can be said for every single product out there, and I think that. By the way, I have two of the robots, one which is for vacuum cleaning and the other one that is for mopping. So quite happy with the quality of the products, and I don't think that iRobots are going anywhere. I'm curious to see whether Amazon will spend more when it comes to R&D and make them better over time. I have a couple of, as you can see, normally I really dislike having links or multiple tabs open. I just keep it simple, but for the purpose of this live stream, I wanted to prepare a bit to have more topics to touch upon. Amazon can pretty much block competition. I'm not sure. I don't think so. There's nothing really stopping anybody else from competing. They're all, especially Chinese companies that can manufacture robots. Antitrust, Tyler, do you mean related to iRobot? Honestly, I don't think it's a big deal. I think the factor that should be seen is the size, and iRobot is not really the biggest company out there. It's not that this is going to change Amazon significantly. So I don't see it as a big deal. I'm surprised that it takes so long to get approved. So that's my personal thought. What are my thoughts on the US economy and stocks long term? Quite optimistic in general. Whether they're fairly valued today, not so sure. I think there's um, a lot of companies that are overvalued today, and of course there are always good deals. Yeah, Amazon. I do have it as well as part of my portfolio. What surprises me the most when it comes to the US is size-wise. For example, if you compare, I don't know, the US and let's say Europe, if you compare the innovation that's out there based on the population, they're by far more innovative. And I'm not sure what is the reason behind that, because I don't think it's so much education. Maybe it is the opportunity, maybe it's the access to capital, maybe there's more of a risk-taking culture out there. And I think that, when a lot of people are taking risks, that some of that will pay and will be beneficial for the entire country, and subsequently, of course, it will reflect in the economy and so on. What do you think HelloFresh can do to expand, create its mode? That's a good question. The way I see it is just broader offering. That's it. Because ultimately, what they're trying to do is provide a high quality service, but it's the more offerings, the broader number of recipes there are there, then the better the company would be. What companies do you think have the best or worst management teams? Maybe I'd focus on the best. And recently, actually, this week I listened to a podcast with Daniel Ek. I have a very good opinion of him as a leader, and of course, he founded Spotify and it has a lot of success there. But I was very positively surprised to hear about his thoughts on leading a company, and especially how to create a culture and how important having good culture is. So I honestly would put Daniel Ek up there in the Spotify management. No, I'm not invested in index funds. By the way, maybe I'm going to close this tab. There was one interesting tweet that I stumbled upon, and I found it funny, so I thought I'd share. Breaking, I'm hearing several reports that Sam was let go by the board after they opened a door labeled top secret GPU room, do not enter. And when they did, they found 21,700 people in the basement of OpenAI headquarters manually responding to all ChatGPT questions. More to come. I thought that was funny. There was a lot of news related to OpenAI, and of course some. To be honest, I'm still surprised that there isn't really anything concrete, because for a board to make such a decision to oust the CEO of the company, there has to be a big story behind that. And whatever that story is, considering it, I don't know, I feel that it should be made public. I think the whole history around OpenAI is quite unusual, to start as a non-profit and being basically owned to majority owned by Microsoft. I'm not saying that that never happens or shouldn't happen, but there should be good reasons for that, and there should be more transparency around that. Jay, thank you very much for joining from Paraguay. I'm not sure what time is it there, but thank you for your support. I really like that there are people from all over the world that just join in, and even to say hello. I really appreciate it. I've met so many people because of the channel, and I think I definitely consider myself lucky to have this opportunity and to be able to afford to make videos and interact with all of you. There were a couple of, speaking of the events of last week, maybe I saw this this report. Tyler, I'll come back to your question after this one. US Black Friday sales rise 2.5% based on MasterCard spending pulse. And this is not adjusted for inflation. So basically adjusted for inflation, probably quantity-wise, I'm not sure, but price, likely that it is worse or less sales compared to last year. But I have a feeling, I'm not sure how it is in the other parts of the world, but I see that this Black Friday, with historically used to be like a one-day event, is more expanding, and it's becoming more of a 1 week event, and one day of that is Black Friday. But it seems there are discounts for a longer period of time compared to what used to be. So I'm not sure if these year-over-year comparisons always capture all the discounts and all the economic activity. Maybe they do. I know there is, I believe, some Cyber Monday next, the coming Monday. So I'm not sure if this is really the best measure at the moment, but I think it gives already some indication that at least this year there wasn't a lot more spending than the year before. And I don't think also this comes as a surprise, considering the high inflation that is out there. In general, when there is high inflation, it takes a couple of quarters and sometimes a couple of years until that is being reflected rightfully in the price, in the salaries of the employees, so then their purchasing power gets to more or less the same level, if that happens, because for a lot of employees that doesn't happen. So I don't think this is a surprise. So if anything, probably it's, I'd say, comparable sales versus last year. Tyler, how would you describe your investment criteria? Are you most looking for high quality compounders, etc.? What does your investment process look like? Yeah, so I don't have necessarily investment criteria that are clearly defined, such as I'm looking for growth companies, or I'm looking for companies that have a certain margins. What I try to do is I try to, during my process of holding certain companies, try to learn more about the company and the industry. This is why I want to be diversified, to be exposed. So I have to read more, and I have to follow certain industries closer. Now, when it comes to, of course, in making the decision to invest, I take a lot of time to go through the reports. I do value the company. I look into the management. I take a look at, for example, press releases that were released historically, the quarterly earnings. I see how good the management delivered on what they promised to deliver, for example, over the last 5 years at least. And of course, the price has to make sense. It has to be at least fairly valued. But I don't mind investing in very boring companies. And I think I've mentioned that in my portfolio updates. I have a company, part of my portfolio is Cakebox. There is absolutely nothing interesting about it. There's no technology that is crazy, or just a cake company. It's a cake franchise. So I want to have exposure to different industries, and I think that the return that I get from it is in different ways. So of course, one is the return in the form of pure financial return, but then it's also the knowledge return that I think compounds. And hopefully, if I continue to do this over 5, 10, 15 years, then that will be hopefully it will add value to myself. I did a video on academy sports and outdoors. It looks really undervalued. I mean, I could check later on and see at least some of the financials, but it's really difficult to provide my thoughts on a company unless I spend hours on it. I can look at some of the indicators, like for example, I can take a look at the revenue growth, I can take a look at profitability to see how it changes over time, to take a look at the health or the balance sheet. I don't mind doing that for a couple of companies later on. Maybe we can take a look into that one, Scott. I don't mind that. ASO, Academy Sports and Outdoor. I've not heard about it, but maybe it is undervalued. I mean, I wouldn't be surprised. There was a fun fact about 80s bubble in Japan. I found it interesting. It was shared by David, who was on this channel a few months ago. It was about 80s bubble in Japan. It wasn't just Tokyo that was super expensive though. Despite Japan occupying the equivalent of only 4% of the landmass of the entire US, Japan is about the same size as California. The value of the Japanese property market was 4 times greater than that of the US. And it continues to make comparison that between basically in 3 decades, the price of land increased by as much as 5,000% in Japan. So the real estate could sell for as much as 139,000 per square foot, which was nearly 350 times as much as equivalent space in Manhattan. By that reckoning, the Imperial Palace in Tokyo was worth as much as the entire US state of California. This is very interesting. If you take a look at, of course, if you analyze the Japanese housing market throughout time, you would see this huge increase in prices. But if you compare that to, and again, the US around this time is a developed country. We're not looking at the US 4 centuries ago. This is quite interesting to see the ratio between how much more expensive the Japanese market was, and obviously fundamentally it doesn't really it doesn't add up, right? There isn't fundamentally a reason for Japan to be so much more expensive, the real estate. Thank you, Scott, for the super chat. I'll look into so later on for sure. Yeah, I'm not sure. I don't know much about it, so I cannot really comment on the leadership transition at the moment. But maybe if there's more time, we can look at it later today. Another tweet that I thought was interesting was when this whole OpenAI drama was going on. Apparently, the CEO of Salesforce, Mark, reached out to some of the employees at OpenAI to basically offer them or to reach out to have a chat, and maybe at some point there would be an opportunity for them to join the company. And first of all, I think that there's nothing wrong with this, right? It's very kind to reach out. Obviously, there is incentive for him to do that because he may get some of the top talent in his company. But what followed was that one of the employees, Steven, publicly shared basically this DM and mentioned, "Sorry, but we are too busy being so back." And first of all, I think that being arrogant in this case, it doesn't add value. I mean, if anybody, for example, if I'm hiring at some point and I see Steven's CV and I do some research, there is no way I'm going to hire him because it just doesn't show what I'd like to see in a candidate. And I'm sure that this will not help him in his career. If anything, this was also a positive PR for Salesforce. I think that the way that Mark responded to this, being just kind and congratulating, it just points out that he's just a person that doesn't care about this whole drama. Just wants the best. At least that's the perception that I have. So yeah, I don't think that this is fair. It's good behavior, but I do see it a lot by individuals who maybe became successful very early on in their life and they don't really know how to, I don't know if the right word is to contain themselves or to behave properly, to add value, and just be modest and just accept that they have some skills and add value instead of being being arrogant. Regression models are based on what the market is currently understating with regards to set comp. It uses fundamentals assessed by equity research analysts, which is how most of the market is informed. I did a little bit of econometrics and financial econometrics when I was in university. One of the reasons was to understand if there's enough financial data, is there any decision that can be made that leads to good, or maybe assessing if a certain decision would be good. And I agree, in general, those are based on historical data, and the most difficult part is that whatever regression model you have at the moment, and that it doesn't have to be a regression, but any model, there is an equation that works for a certain period of time and then it doesn't. So if it was easy to make decisions based on historical data in the form of running regressions, then everybody would be doing that. And if something is too easy to be done, then there is no significant return that you can expect. When it comes to the fundamentals, I think there's something that I see sometimes, and that is there's a lot of focus on the fundamentals in a sense on the financials point of view. So let's take a look at the income statement, the balance sheet, and that's all great, but that is a very small portion of the company, because that is also historical, and we're going to the same discussion that's historical and that changes. And it's important to take a look at the environment that the company operates in, to think of, are there certain events that could happen that would either have positive benefits on the company or negative maybe just harm the company. I'll give you an example. If I take a look at Take-Two as a gaming company, if you focus only on the historical numbers, basically you're assessing how well the games that they released historically are performing. But if you take a look at what's in the pipeline, then you can think of what's coming next. And the difficult part is, and that's basically where all the return lies, is to assess, are these games going to be performing better than the ones that they released historically? And if you're better at estimating the performance than the average person, then you'll be making money. But it's not an easy task to perform. And if you think about it, this is true for everything out there. Every company will have certain challenges in the time to come. So it's up to you to figure out, can the company navigate successfully through that? What's your opinion on AI in general, and do you plan to analyze and possibly invest? So I've read a bit about AI. I have a couple of books that I want to go through more to understand really the fundamentals of it, because I do know a bit of Python programming, but I'm not an expert when it comes to that. I hope that AI will have positive impact. There are a lot of use cases that will add value. The question is, can you choose the right company that is going to perform well in the long run? And I don't feel comfortable in that. So I might analyze companies, I might analyze the technology behind them. Investing, I'm not so sure, solely because I don't think I have what it takes to guess which company is going to be the one that is going to be on top of it, over the next 5, 10, 15 years. Because a lot of this is developing so quickly, and the company that is doing so well today, that could not be the case a year or 2 or 3 from now. So if you take, for example, at I don't know, ChatGPT, right? One of the first GPTs that became public, that became everybody had access to. There's a lot others like that today. So I'm not sure who is going to be the number one. And of course, this is one example of AI, but there are a lot of others. I'd like to see it more in helping companies such as, for example, Zillow, that's real estate related. I'd like to see that more there. Steph, what do you think of the real estate bubble in MK? I guess MK stands for Macedonia, or now North Macedonia. I think that there should be some regulation in a sense that if somebody owns 2 properties, then the same person can get a third one only if that property is above a certain price, because the concentration of the properties is in the hands of not as many as in other countries, and that makes it, of course, the demand is there, but there isn't enough supply, so that pushes the price up. I think that a regulation of some sort should be there. And of course, if you think about maybe the criteria for obtaining a mortgage, I think there should be like, I don't know, 20-25% down payment, which is really difficult for many to save that much money, because they're all the expenses that they need to pay every month. So it basically, the current situation is very difficult for the average person to obtain a loan, and of course the prices are being pushed up. I don't know if that's sustainable. I don't think so, but how long would it take to get to normal? I'm not sure. Arrogance over confidence, the biggest destroyer of power. Yeah, I think so. I mean, ultimately, it would be great if, everybody does their best to bring something, kind of being net positive to the society, and that's it. I think it should be simple as that. Leverage is the destroyer of wealth. Yeah, could be. Vince, thank you very much for dropping by. Yes, Scott, I have joined Scott twice on his channel, so if anybody wants to, I wouldn't say see my brilliance, but if anybody wants to look into that, feel free to do so. And by the way, Vince had recently a video that I thought was interesting, and it doesn't do videos of that kind very often. I don't know if this was the first one, Vince, but I found it interesting because basically Vince is a real estate developer, and one of the things that he does is there are properties that are owned by him or his company and are being rented out to somebody who lives there. And he had an example where something went wrong. I think it was the earth that went down. There was challenge with electricity, and he just explained that if I have to call the technicians to get this fixed, basically at least 3 months of my profits are gone, maybe even half a year. So it is interesting to see what can go wrong, because there's a quote that everything, or the grass is greener on the other side, and I think that is the case for real estate as well. So everybody thinks that because somebody does it and is successful in it, then it has to be easy and they want to join in, but it isn't. And everything that you do, regardless of what you choose to do, there will be difficult times. And yeah, Meta my pick for AI. Could be, babe, could be, Scott. I mean, it's really difficult to judge. I see some of the developments around it. I think they have a lot of data, so it could be right. What's my favorite investment? Do you have any big winners that you could highlight? Some learning lessons from? Do you have any big losers that you learn from? Those are great questions, Tyler. I think I have a few winners, at least winners in the making still, but they're performing well. And to me, those are companies where the sentiment has changed so much. They're being hated for the recent results, but fundamentally, the business is still strong and continues to perform. So sometimes there are very good businesses that they're being impacted by some certain event that is temporary in nature, and I think that is for me an interesting opportunity. When I understand the business, I'm just waiting for that price drop. I looked into, I think it was Volkswagen, and there was another car company. Both of them did not at the same time, but at different time frames. They were involved in I think it was emission testing scandal. So they had these devices that were testing for the emission of the vehicles, and what they did was they figured out that they could trick these devices to measure a lower emission that the cars were actually emitting. So at some point, of course, this is being public. It was all over the news, and the share prices of both companies, based on those news, dropped significantly. And of course, what was expected is there would be a fine because of that, because obviously that's not the right thing to do. You cannot perform that way. And if you take a look at the price decline, that was way too much if you compare it to the fine that they paid afterwards. But there was the expectation that because of this emission now, their loyal customers are going to no longer be their loyal customers. They're going to switch to another company. But in reality, that didn't happen. I mean, think about, I'm sure that if you speak to, 50 Volkswagen car owners, I don't think they'll make the decision based on a certain scandal, 2, 3, 5, 10 years ago. So these are kind of events that sound scary, But if you take a look fundamentally, what changes, there is not really that much that changes. So, I would point out to events like that. I'm interested in that, but that's of course very subjective. I'm interested in that to see how irrational the market is, because the market is oftentimes irrational. So many people don't think like that. Yeah. Vince, I think it's what you do is very different, and people want to brag about the good things, like, oh, this is what I made, and it's all good, but it's very important to be objective and show the other side of what can go wrong. Hey, K9, thank you very much. Is it a good time to invest in Apple even though the price is at an all-time high? Planning to start investing and I want to start safe. Well, by nature, if you start investing, regardless of what you invest in, safety isn't something that you should expect, at least not in the short run. Probably the index investing is the one that's least volatile in the long run. I think there was a statistic that over the 3 decades, you're anyway going to perform incredibly well. As for Apple, at the moment, the way that it is, personally, I don't think that it is a good investment opportunity for me, but it could be that I'm missing something, right? So if you think about it, Apple has certain products and services that it offers today, but imagine if there are certain products and services that you can envision that I can't, that eventually make the company much better than it is today. So I don't know, maybe they introduce an iCar or something. Maybe there are a lot of other services. So far, I'm not very optimistic, because all the news that I hear when it comes to, and I'm not referring to analysts, I'm referring to different kind of news, in the sense that there are discussions that maybe the fee that they get for their store would decrease. These are kind of events that could happen. So I see a lot more negative surprises in the coming period rather than positive ones. But those are just my personal views on the company. Let me see what's the next comment. Some business might want to get priced because of a low ESG score. Sure. I mean, if you think about ESG, right, it's all about whether the company is behaving well, right? Is it a good corporate citizen? This isn't new. I think the whole ESG is more of I'm not a big fan of it, because it's just a lot of companies make money out of it because they get to work on ESG and they get to create all kinds of fancy reports and long reports that very few people read. I think ultimately any investor should personally assess whether a company is a good corporate citizen or not. So for example, if you think about the tobacco industry, if you dislike those products and you think that those products have negative impact on society, then maybe you would assess that company is just not worth for you to invest in, or you just don't support that kind of products, or that the companies in that industry. The price of real estate is 100% increased compared to 2019, which is unbelievable. Do you think that the prices will come close to 2019? Without any legislation, no. I don't think they will they would basically cut in half. No, because if you think about it, the prices move depending on the demand and supply. And I don't see how those two forces will significantly change in the country. Except there's legislation, which is also unlikely, considering that, you know how it is in less developed countries, those who are in charge of the legislation are the ones who anyway have or benefit from it. So I don't expect decrease, yes, but not to like a 50% compared to, or a decrease of 50%. Question marks, please keep making incompetent management videos. They're very informative. Thank you. I'm glad that you enjoy these videos. There's a lot of managers out there who have created positive sentiment around the company, and they're being praised, but I think that the ones that are doing poorly aren't really given it as much attention. And I think that in general, there is not a lot of research when it comes to the management by people who are investing, the retail investors especially. It's more, let's take a look at the financials, let's take a look at the standard financial ratios, the PE ratio, the valuation. That is the easy ones, but that's not really enough. The relative valuation understands that and uses it. Intrinsic value right, but it fails to recognize that the market is irrational. I mean, I'll argue that the relative valuation isn't any better in that sense, because if you have, let's assume that you have 5 companies and you do a relative comparison, it seems that one of them is the cheapest, right? And it could be that you see that one rising in price, right, to kind of meet the same pricing levels or valuation levels as the other 4. But what could also happen is that these 4 are also undervalued or overvalued, and the price goes down. So I'm not a big fan of relative valuation. The only um, the only cases where I do use relative valuation is not so much for investing, but when I want to assess um, certain assets that a company owns. So for example, if I want to take a look at a social media company, I'd like to see the users that it has versus the other companies, how much revenue each one generates. Because of course, if you have 100 users that are generating $10 and you have 100 users at another one that are generating 50, relative valuation is one where you can see the pricing potential or the potential for one to monetize the users. And you could think that this one that is generating 10 could expand, but it needs to provide certain value. So that's the only place where I use kind of relative comparison and ultimately a relative valuation. Then, so I think Apple is only a good investment if you don't want to park your money in cash. Maybe if in Apple you get a bit of return, maybe. But if you want good returns, Apple is not good. Yeah, thank you for sharing your views. Do you equate risk with volatility? If so, how does it coincide with you actively investing? If not, how do you define risk in your investing? So uncertainty can go both ways, right? So you could have a positive and a negative surprise, and risk is more considered the downside, so what could go wrong. So when I do look into a company, I try to envision the different paths that it could go. It could the kind of the best case scenario, and I'm hoping for that, but I'm not based on that. I'm trying to figure out what is the worst that can happen, and if that happens, will I be still fine? And it's more of a maybe safe approach. Maybe I'll miss on a lot of very good companies because I was too scared of this bad scenario. But sometimes what happens is that this bad scenario, what I think is bad, happens, and the market overreacts, and then is my time to actually jump in. So it happened with Upwork as well. I think I'm about 50% up on that company, and it's I don't mind jumping in. And I think maybe HelloFresh is at the same position. What are your thoughts on portfolio diversification? Do you diversify with different types of assets? I don't invest in other types of assets. So it's only assets, but I do diversify across countries and across industries. Are you ultimately making decisions based on risk to reward or Sharpe ratios? Not necessarily on Sharpe ratios, but I do take some time to understand discount rate. So for example, why would there be an 8% instead of 12% discount rate? So I want to understand that part. And in general, there are 3 ways to adjust for risk, right? The first one is, I made a separate video on that. I don't want to repeat myself too much, but you can do that in the numbers itself. You can do that in the discount rate, or the third parties. You could not adjust any of those numbers, but then require a certain margin of safety compared to the valuation that you got. So no, I don't use the traditional risk to reward or Sharpe ratios or any of that sort, but I do spend really a lot of time to understand, what is this company doing? What are the competitors doing? And I think that the one thing that I don't see it addressed too much is, what does it take for a company to get to a certain point? So for example, if you think about a car company, it could be Tesla or it could be any car company. They have a certain capacity. If you take a look at any company that manufactures products, they have a certain capacity. So inherently, if you assume that they're going to double their revenue because of the volume, if they don't have enough capacity, then they need to build a factory, or double the capacity somehow, whether that is by subcontracting or not. And it makes sense to, whenever you're creating a model, if you're the person who enjoys creating these models, to make sure that the story lines up. So if you are to add only one thing. If you say, oh, I'm going to, increase the revenue, but there isn't enough capex out there, you're overestimating the cash flows that the company will earn. Thank you, Ale. Thank you for joining. Yeah, maybe before I move to HelloFresh, and I still want to go back to the company that Scott mentioned. This is something that became public recently. The CEO of Binance, or now ex-CEO, stepped down, and apparently it's because of some. Shall I zoom in a bit, maybe? The company, as part of a plea deal, agreed to pay more than 4.3 billion. I mean, I don't know. Thank you, Tyler. Glad you enjoyed. I'm not sure which way this is going, to be honest. I remember that back in, I think it was 2012 or 13, I had a conversation with somebody who is really pro cryptocurrencies, and he's really positive about it. And I wasn't so much, and I'm still not, because I don't see really the difference that they're making in a positive way. So I'm still waiting for something. I mean, in general, I hope that whatever comes up will be positive, but at the moment I still don't see it. And if you take a look at what's going on, yeah, money laundering and sanctions, and I doubt that Binance didn't have any issue on any information on what's going on. So yeah, I mean, it phases up to 18 months. Come on, it whatever happens, I hope that it sends a message, but I hope that all of this moves into an environment that makes more sense. Thank you for joining. Well, let's see how the party gets or continues from now on. Now, of course, when there's an event of that kind, there's a lot of fear that maybe the Binance will go bankrupt. And there was, based on this article, about $1 billion in net outflows over 24 hours. And this is 22nd of November, so that is 4 days ago. So if I take a look at an event of this kind, even though I don't follow crypto as much, and I'm not really planning on investing in any company of this kind, what I'm curious is to see how this particular event has an impact on the other companies, such as Coinbase, for example, right? Because, the users that withdraw 1 billion, they're not going to sit in cash for sure. The question is, where would this 1 billion go? So it may be part of that goes to even Robinhood or something. So this will be interesting to see what are the companies that benefit from Binance. What do you think are about WEC not penalizing high leverage of high tax, also relying on beta for cost of equity? I assume you're not in the efficient market camp. Yeah, I'm definitely not in I don't think the market is efficient. So the way I look at it is, if a company has a high leverage or high tax, right? So let's take a look at those two segments, right? So if a company has high leverage or high debt position, inherently that company is more risky than another one. Now, if you take it through the weighted average cost of capital lens, that is a benefit, right? Especially if there's a high tax as well, the cost of debt is low. Does it make sense? Probably not. Now, the efficient hypothesis, the efficient market in general, it argues that when this is the case, then the riskiness would be reflected in the beta of the company, which isn't always the case. This is why I do use the weighted average cost of capital, but I don't take it for granted. So I try to challenge it and figure out, does this make sense? So if, for example, there is a company of this kind, I do want to understand, wait, why do I have such a low beta? Does it make sense? So as such, I don't think that I don't think any financial metric should be taken for granted without really further questioning it. What do you think about crypto investments? Do you think mass adoption is around the corner? So here's my rationale, and I could be wrong on this, but my question is, we have an alternative investment, fine, but what is its purpose? So for example, if you take a look at real estate, right, it provides value. There are people that use it as a house, they stay there, they live there. it provides value to them. And the one who owns the house gets paid, whether that's in the form of rent or whatever that may be, and at some point maybe capital appreciation. What is the, like, if I have 1 Bitcoin or 10 Bitcoins and that's it, it basically, for me to make money, it means that somebody else needs to pay more. But there isn't really usage of it. So if, for example, I saw that, I don't know, there were a lot more transactions, like really meaningful transactions, I would say, hey, this is being used as a currency. So I'm trying to see both cases, whether it is a store of value and the transaction in terms of currency. And if I saw a huge increase in transactions and they're really, I'd say transactions that add value, but I don't see that at the moment. It seems as the majority of the buying and selling is just for making money out because somebody else will buy at the higher price. And I don't know. I don't know which way it's going, but I don't see crypto adding value. I don't see crypto adding value to the world, or at least making it better at the moment. How do you do relative valuation? Do you just compare PE ratios in sector? Not really, no. I don't use any single metric as a comparison, because you could have two companies with the same PE ratios, like completely identical, but one having a lot more cash. That is not being, maybe that's not reflected. So the PE ratio can also be misleading. Maybe the management is a bit worse in on. So instead, what I do is I just take a look at all the interesting companies that I think are real competitors, and I try to value all of those individually to really understand is there any competitive advantage in any of them. So the way I do that is, of course, very time consuming, but then I really understand how they're being priced relative to one another after taking all of those accounts. Yeah, zero utility indeed. Like, I could be wrong. I mean, I hope I'm wrong. I hope that something comes out of it, because there is a lot of discussion around it. But the way I look at it is there are more cryptocurrencies being created. The utility doesn't increase over time, and it just continues moving. And same goes with NFTs and all of these interesting projects. Why not just make money? Could you elaborate a bit more on that question? Do you mean from cryptocurrencies? Was that what you're referring to? Yeah, in the meantime, I stumbled upon this article where Netflix pays filmmaker 55 million for a sci-fi project, but he gambles away at least 11 million on trading stocks, buying Dogecoin. Yeah, I'm not really into trading. If I don't understand something, then it's just not for me. If I don't see a clear path forward and it's not something that adds value, then it's just not for me. Because imagine this. Imagine that I buy Bitcoin and tomorrow it goes down to zero. It could. I mean, there is no case that doesn't happen, but of course it's highly unlikely. But why am I hoping for a higher price? Like, why? What am I expecting to happen? And I don't have the answer to that. I don't see the value. I cannot value Bitcoin. I cannot. So, and of course, you're right, Restom, that crypto is not just Bitcoin, of course. And I think that if I think about the technologies, the blockchain, of course, that on its own has value, and it is being used around the world, and that on its own is adding value. And I'm sure that there will be a lot of projects and crypto currencies built around that for a particular use case, like tokens and stuff. And that, some of those projects will be valuable, but Bitcoin is the most valuable one, and as such, that's why I address that. But I agree with you, crypto is not just Bitcoin. And some of them will for sure add value. It's extremely easy to value. It's all based on narrative and hype. Yeah, it's easy to speculate, that's for sure. Yeah, I think this was an interesting article. And I mean, there are probably so many cases when certain projects were funded and then that whole deposit was gambled away. So, as you can see, it even gets down to Netflix and they also make poor decisions. I'm surprised that they just sent wired money to somebody like that. And I don't know, maybe that's a standard, but I doubt that they have no contract that will get the money back. I think if you want to compare companies with different capital structures, then EV, EBITDA plus maintenance capex or something similar makes more sense. Yeah, I would even, yeah, I think that makes more sense. I agree, Dragonfly. I agree. I think that makes more sense. The only thing that you might miss there is that those are all historical. So if you have two companies with the same EV, EBITDA, and maintenance capex, but one is growing much faster, one is growing much slower, then you might miss that. And also, if you have certain, like, I'll give you an example. There was, I won't mention the company, but there was a company where their manufacturing plant burned. One of the plants burned, and what happened was, of course, they couldn't meet the demand at that moment in time, so their competitors took a portion um, of their customers, but that was temporary. So if you're looking at that company at the time when their factory burned down, the year after that, they had poor results. So if you use that particular year for comparison, you would say, well, this company is doing quite poorly. But after that, of course, they got the whole factory rebuilt. It was also paid because they were insured. So yeah, it's really difficult to look into companies based on solely on certain ratios, including if it's EV to EBITDA. But I think it's better than taking P ratio. That's my thermal. I have not heard of that one, but maybe we will look into that. I have an interesting question. What I see as a difference between your investing and my investing, for example, is that you tend to take very conservative choices. So I think definitely more conservative, definitely. I think both approaches are completely valid, but if you want to reach 1 million, for example, with your method, one needs to add more money per month, but one more safely reaches. Could be. I think that, of course, taking more risk is either going to help you become reach 1 million earlier or not at all. I agree. There's always the trade-off between risk and the reward, and of course you need to find the approach that works for you. And I know that you have a few holdings and you have done your homework and you're confident in that. There's nothing wrong with that. Red Storm, we're on the same site. Good. That's good to hear. Why do companies target capex at the same level as depreciation? I don't think that is the case always. The only way that I can imagine that if it's the company is mature, because if you think about what depreciation is, right? It is taking the value of the asset, the historical cost of the asset, and depreciate it and spread it over a period of time. And after that time, you would need to buy the very same asset. I mean, think about something that is similar. Like if we take a dentist, right? Somebody who has an office, they have a certain equipment that they need to have, right? Like a chair and all the tools and all that stuff. And if somebody opens an office of that kind and buys all the equipment, then the depreciation would be fixed over time, right? But then at year 11, when everything needs to be replaced, then capex would be for all the 10 years because they're going to buy all the equipment at once. So if you take a look at something that is very small in size, then capex and depreciation would not match at that point in time. But if you take a look at somebody who has 10 companies of this kind or 100, then every year there is depreciation and there is a replacement somewhere. As such, depreciation and the capex tend to go hand in hand for a company that is stable in size. But if you have a company that is growing 20, 30, 40, 50%, and it is capital intensive, then capex would be much higher than the depreciation. But there's also the investment that is in working capital. So, for example, the thing is there, depending on the business, but for example, accounts receivable, accounts payable, inventory, if you suddenly have to service 20% more users, if you have to service 20% more customers by providing more goods, you need to have more inventory. So you have to prepay for that. So there is some capital that will be tied in the form of inventory. Yeah, you're very welcome, Dark Knight. Yeah, Vince, I agree. I don't think there's any one method that works for all. If you take a look at Warren Buffett, he has his style. If you take a look at Peter Lynch, he has completely opposite style, and it hit it quite well. So I think my approach is in general try to understand what the others are looking at, try to understand their thought process, but ultimately when I make decisions, I'm trying to figure out what works best for me and what I'm comfortable with. Rowan, how long did it take you to understand accounting and financial reports as you do now? I'm at the end of my first year of accounting classes, and I'm not nearly. Yeah, honestly, I assume that the first year of your accounting classes, I assume that you're referring to university. Don't have high expectations when it comes to that. University is maybe. I'll switch this so there isn't really just an ad running around. The way I look at it is university does a good job in maybe to some extent forcing you to study because you have to do that in order to pass, but it doesn't prepare you for delivering value to whoever hires you right away. At least most universities. So I think that it would take you, depending on the companies that you work for, years. And I'll share a bit about what I did. I joined PricewaterhouseCoopers. I was part of the financial reporting department in a way, so it was called tax reporting and strategy. I worked with a lot of companies that were primarily small and medium-sized, and I was initially doing the bookkeeping part. So, and that's incredibly important. So if you get to do that, I think that that's a good starting point because you get to see the lowest level of transactions, really all the invoices to understand how that works, what can go wrong. And then over time, you figure out how that all blends into the balance sheet, income statement, cash flow statement. And of course, once a year, there were all the annual reports that needed to be prepared. So in the first 3 years of my career, I got to already work on creating annual reports. Not the ones that you see, the 10K, for example, those are not that complex, but still there was complexity and there was a lot of notes that needed to be prepared. And after that, of course, being part of a very large international company, being part of the financial reporting department there, I even get to see even more and being involved in mergers and acquisitions and all that kind of stuff. And then the complexity becomes on a different level. And what I would say is, don't rely only on education. It's just the beginning. Try to get a job where you get to learn and try to make sure that the people around you are ones that know a lot and are willing to share that knowledge. Because I was lucky that in both of these companies, I have incredibly knowledgeable colleagues, incredibly kind colleagues, and I can drop by somebody who has a lot of experience, drop by in his office, ask questions and get a response. And I hope that I get to do that at some point as well. But I don't think you should have a certain time frame like, oh, you'll have this knowledge in 2, 3, 5 years, because ultimately, you get to learn more and more. I was really disappointed about the company in Europe. I only bought 3 companies. Europe is in an interesting position, and that's the part I don't really fully understand. I have owned very few European-based companies. I think that there are opportunities, but not in the large cap companies. Maybe medium, maybe even smaller or micro-size companies. What type of companies are you most comfortable analyzing? I mean, the easiest companies to analyze by far are the ones that are mature and there's very little that happens. It's not necessarily industry related, it's more the maturity phase. So if you take a look at a certain family-owned business that does the same thing every single year, has stable clients, the revenue is pretty much flat, the profitability is flat, or maybe moves everything in line with inflation. Those are the easiest one to analyze, but of course that doesn't mean that that's when the most return is. There was a question at the very beginning from Marcus. He asked for HelloFresh, and I think maybe I can point out also to the price of HelloFresh. It's down. It's 38% over the year, but it's actually down almost 60% in, it's probably like 2 months, right? So I'm lucky to have trimmed the position pretty much close to the top. But what happened, and one part of that, at least this last drop here it's almost 30%, was because of them reducing the guidance. So they narrowed the revenue growth and lowered the EBITDA outlook for the full year, or for fiscal year 2023. And if I take a look at, of course I got the notification for that, and it was perceived as a very, very bad news. But if you take a look at the revenue growth, it was before estimated between 2 and 8%. Now it's between 2 and 5%. So they basically do not expect that they grow 8% year over year. And then when it comes to the adjusted EBITDA, it used to be a range between 470 and 540. Now it's between 430 and 470. So is there a decrease? Absolutely. Is it one that deserves a 30% decrease in price? I don't know. I don't think so, but this is what the market thinks. They don't maybe trust the management so much. Maybe this is not the same trajectory as many had envisioned for the company. So there's nothing wrong with that. But I hope that I get to add more to that to my position in the period to come. I've heard good words about you directly from some of the top management in PwC. Redstorm, I'm assuming that you are working there now. First of all, that's good to hear. Thank you for sharing that. I mean, in general, I also have positive opinion about, I wouldn't say all colleagues, but most colleagues that I had there, and I was very fortunate to work with really, really nice and knowledgeable people. Maybe it is a good idea to make live analysis of companies, so people suggest companies that we can go through. We can do a little bit of that in this stream later today. I'd like to start with the one that was suggested by Scott earlier today. I think he mentioned ASO, so I'd like to start with that, but it's really difficult. This is why I try to avoid live analysis, not because it's not possible, but because if you really want to go into the details, it would take us a lot of times. Yeah, adjusted EBIT. I agree. I don't really follow that term, so my valuation is based on purely EBIT, so no adjustments of any kind. But if I take a look at, basically their adjusted guidance is, I think it was 2% below my expectations for this year. So actually, my expectations were that they would underperform this year. So that's for that reason, my thesis doesn't really change around HelloFresh. So I hope to add more in the coming period. Now, ASO, this one was suggested by Scott. I'd like to take a look first what the company is about. Sporting goods and outdoor. Let me know, by the way, if I should zoom in a bit or if this is readable. Outdoor recreation retailer and in the US. Camping products, coolers, drinkware, camping accessories, sunglasses, backpacks. So quite a broad offering. So this would be my first step to understand what it is that they do. It's founded back in 1938. Okay, that's quite an old company. Market cap 3.7 billion, an enterprise value 5.1, which basically means that they have quite some debt, close to 1.5 billion. So we can take a look at the balance sheet as well. 1.5 billion. So let me take a look first at the company to understand what is going on from a purely income statement point of view. They were growing in 2021, 2022. Maybe that's related to COVID to some extent. I'm not sure if the demand for camping related products, for example, went up, but could be. And now 2023, so this is basically pretty much 2022, down 5.6%. And this, maybe we can take a look at the quarterly ones. But it seems that the revenue is declining a bit, which is already a bit concerning considering that there is inflation. So one would expect that there is actually, if the company has pricing power, then that should translate to higher revenues. But this is one of the things that I'd look at. Maybe let's go back to the annual one. So they don't have, that doesn't seem to be any pricing power. So they probably sell less products, but that is something that, so normally what I do is when I look at a company, I'll have an Excel opened and I'll just note down the questions and both the statements. So for example, here I would say no, seems like there is no pricing power, but what I would do is I'll try to check in the annual report. Is there because I anyway go through it, is there any split of products, and if there should be some information about the volume. Did it go up or down? I would expect in this case that it went down, and I would like to see the management commentary around that. Then if we take a look at the operating income, this is very positive, because basically, even though they are much bigger in size, they have not increased their SG&A as much percentage-wise, so their margin naturally increased. The same goes for the gross margin. So this seems a bit interesting, because if you take a look at their cost didn't increase as much. But this is just a very, very high level screening, and I'll have, I don't know, probably like 30, 40 questions maybe for a company where I don't know the answers, but I'd like to look into a bit further. So basically they're earning about $500 million in US dollars in a year. So $500 million for a company that has, what was it? Less than 5.1, market cap 3.7. It seems, right, based on the traditional metrics, pricing, valuation wise, undervalued. But then I would like to see also the balance sheet and the cash flow. So if I take a look at, and this is maybe related to, thanks, Vince, thank you very much for joining, and enjoy the rest of the night, get some sleep. I think this is to some extent related to what we spoke earlier, that the depreciation and capex is related. So if you take a look at 2020, depreciation was 117. Yeah, I can expand this a bit. So 130, 130, 120, 105, 105, 106. So it's not that volatile, which is expected. If you take a look at the capex, 130, 107, 60, 40. 76. So what you'll notice here is that the management was more conservative around COVID times. They didn't probably want to take too much risks to spend too much, because they were not certain how much demand there would be. So this is likely the case, but again, it still requires additional checking. And then now they increase it. So you see that now there's about 70 million more capex than depreciation. So they're expanding in terms of property, plant, and equipment. I don't see any significant, I say, low activity when it comes to sale. I don't see any acquisitions, any divestments. I see that it seems as that the debt is being repaid. I see a lot there. I see a little bit of common stock issuance, which is probably not really significant, but they're buying back commons, or they're buying back shares. So probably the management thinks the company is undervalued. There is some dividend, which is irregular. I'm not sure if you can see it at the moment from the camera, but so overall, it seems as if the company is making a decent amount of money. Now, if you use Ticker, you can also take a look at the expectations for the next years. You can look into this. I don't know how useful analyst estimates are, because ultimately there is very little that we all know about the future. We can all make guesses. But what I would do is, to understand this company better, go through the annual reports, try to see if there's investor presentation, try to see if there's any guidance that the management provides about the coming years. And, maybe the company is undervalued. I mean, what I look into is, because it is based on the description, this is a company that sells products, I want to make sure that there isn't really a lot of inventory excess compared to, or it doesn't become worse over time in managing inventories. And in this particular company, I think that's not the case. I think this seems more as a turnaround company, because if you take, and probably there are some ratios inventory related, 3.04, 3.84, 3.1, 3.12. So that is the number of times the inventory turned over throughout the year. So in general, you want this number to improve over time, or at least to not get worse. Because if you have a company that grows 20% in size, but their inventory grows 40, 50%, that's not really sustainable. And also that is to some extent a way for them to artificially increase the profits. And I don't know if that's being discussed that much, but I think it's maybe I should. Would we? Let's go into that. Let's get into that. Why not? So if you think about any production of products, there are certain fixed costs that are being distributed to all the products that are being manufactured, right? So if you have more products manufactured, basically the fixed cost per product is lower. So what you have is you have manufactured a lot of products at a lower cost if you maximize the production. But if you cannot sell all, basically what you have is a lot sitting there as part of your inventory. But when you sell whatever, even if it's 10%, 20, 30%, once you sell those, basically your margin is higher because basically you're saying, hey, this is how much I earned by selling these products. The cost, based on our costs per product, this was the cost, and you get much higher margin. But in fact, you have so much product sitting there that you just didn't manage to sell. And if you see that a company, the inventory of a company goes up significantly and it's not being sold, then you know that basically the profitability isn't isn't fair. And at some point, maybe they'll need to impair inventory, to write off. That could happen. But here, for example, what I'd like to understand is there's a lot of goodwill, in almost $1 billion. So I'd like to understand what happened there, because there doesn't seem to be any acquisition over the last 5 years. Doesn't seem to be an option for the management at the moment, but maybe again in the future. So I want to understand that. But what I really like is that if you take a look at the debt, it seems as if they're focused on paying it down, which is quite good. And if you use any platform, including Ticker, for example, if you take a look at the total debt, you won't see a significant increase because there was a new standard introduced, I think, both in the US, basically all over the world, and that was related to leases. So if you see as of 2020, this is in this case the first year that you see capital leases on the balance sheet. So even though they went from 1.6 billion in long-term debt to 0.6, and the current portion isn't that significant, it doesn't seem as that happened, because if the starting point doesn't include capital leases, and this is a significant portion. I do think that thank you, Dragonfly, for joining. In that the small cap has some real bargain, definitely. I mean, SG, I think there are always bargains. It's only a matter of putting the work and figuring out what others don't. In general, it doesn't. I think a lot of individuals aren't willing to do the work, and it's always easier to just buy stocks, and that's it. Can you see the term structure? No. But that is definitely something that I do check, because the term structure, the percentage, if they're due in 2024 isn't the same as if the debt is due in 2028 or in 2040. I think I have a good example for that, and I have the link. I looked into Verizon at some point, and I looked into Warner Bros. Discovery. And maybe some of you have heard of it, 27 billion in market cap. I actually have a link to the annual report, and I think it's interesting to see. But this particular company, I know that many of you are familiar with at least the cartoons. If you take a look at the financial statements, if you take a look at their debt position, non-current debt, I'm not sure if you can read that well enough, but they have about 49 billion in non-current debt. And again, if you compare it to the market cap, this is quite a lot. But if you scroll to, let me see which node it is. There's a debt structure. You will notice that here. I think this is very important, because if you analyze a company, you need to look into the maturity. So actually, out of the 49 billion, this is including the short-term debt, only 4.5 billion are really short, relatively, or mid-term, let's say, in 5 years or so. Then there you have the senior loan, so there's 12 billion. But if you take a look at this one, 21 out of the 49 billion are to be paid 10 years from now. So this is different than if they had to pay and refinance this next year. And of course, the interest rate is also stated. So if you have a company that has a high debt position, look into the annual report and try to understand if this is something that will cause them to go bankrupt, or maybe this is something that, you know, it's not great, but they could go through this difficult period over the next years and figure it out. They have enough time or not. Let me see. I think there was some suggestion earlier. So maybe we can spend the next 15 minutes, half an hour or so to look into certain companies that you're interested in. But it would be really difficult if those companies are related to AI, for example, because we don't have enough time to really go to the technology to understand. One company that I'm neutral, let's say that way. There is a company that is quite good in terms of financial results, but somehow the management continues to, and I think this is why the share price isn't where it should be. InMode, maybe some of you have heard of it. So if you take a look at what they do, I mean, you can take a look at the service that they provide and the products basically that they sell. But it's medical related, and it's, you know, aesthetics, and they have a lot of presentations. They have a lot of videos on how the procedure is being done, the outcome. They have really a lot of case studies, and I mean, I went through all of that, and that all looks good. But if you take a look at their market cap, 1.9 billion, and they have enterprise value of 1.2. So basically, they have close to 700 million in excess cash, right? So they have 700 million in cash, and they have basically no debt other than some leases. So the company isn't risky as such, but the question is, what are they going to do with all this cash? And I just thought that, you know, if you have so much cash sitting there, you need to do something with it, because otherwise you're not really creating any value. And then there was this this question was asked. The CEO, I think, or the CFO, I think it was the CEO that was asked this question, like, what do you plan on doing with all this cash that stands there? And the question, I think, was a perfect one. So the analyst asked that, well done. The answer was one that I didn't expect. Basically, the answer was, well, we wanted to buy back shares because we think that the share price, the company is undervalued, but we're not sure if that will raise the price up. I mean, you don't buy back shares hoping for the price increase. You just buy shares because you think the price is undervalued. And what happens afterwards, it's not within your control. So using a certain example of what happened sometime for some company, I think it's pointless. And I think that particular manager didn't understand the reason behind, the rationale behind share buybacks. So at the moment, they have so much money with no good idea what to do with it. And that is, that is what makes me question the company. But if that was not the case, if they said, hey, we're announcing share buybacks, I think the share price would increase significantly, because, you know, if you take a look at the profitability, they're doing quite well, generating, you know, last year 200 million in operating income. Take a look from the cash point of view, a lot of that is getting translated to free cash flow. So, you know, earning 200 million for a company that has 1.2 billion in enterprise value, that is a good valuation. Yeah, it's not just the machine, it's not just the machines that are there to be sold. There are really a lot of things, and I think the starting point for my analysis was, is what they do going to have higher demand over the next years or lower demand? And I think that if you take a look at the descriptions, you know, aesthetics, I think that living in this social media, Instagram world and all that stuff, I think that they will have higher demand for their products. So whether that's for the right reasons or not, I mean, really difficult to say, but yeah. I hear so many CEOs who really need to read The Outsiders. Actually, it is on one of the books on my list to read. I haven't read it, but I have heard a lot of positive comments on it. Benjamin, take a look at Basic Fit. Basic Fit is one that I'm at least familiar from a operations point of view, because it's a gym, and I listened to I think it was a podcast when Basic Fit was basically pitched. But this was probably 2 years ago now. So I'm not sure how well that did. Not that crazy well. So it operates as basically it's a gym in Netherlands, Belgium, Luxembourg, Germany, France, and Spain. And 1.7, 1.8 billion market cap, a lot more in. So the companies, the gyms tend to be, I have some friends who have gyms who operate ones, and in general it's all about increasing the number of clients, and retention is the second question to tackle. And as long as people are paying, a lot of these gyms are kind of focused on signing up as many clients so they get the monthly fees, and then whether they join in or not, that's not their concern, which isn't really the best approach, as the value is not being provided, but it's also not always a lot that they can do. So there was definitely a lot of growth. Like, for example, if I take a look at this particular company, the first thing that I would do is I would like to understand how many gyms, how many locations were there over time. So not only do they grow the revenue, obviously they do they grow the number of locations, and do they grow the revenue per location? So those would be my first, the first things that I would look into. Because if they grow in the revenue by 20%, but they open 30% more gyms, there's something to be seen. So that would be something that I would look into. If I take a look at the expenses, I mean, like the same thing goes there. So margins wise, and it takes sometimes a year, sometimes even more, for a certain gym location to reach its potential, because the number of members increases to some extent over time until it reaches the peak, and that peak is basically when the gym location is really profitable. So until that point, it could be that certain locations are even losing money. So but the high debt, for example, isn't that concerning, because probably most of these are I'd say leases. 1.3 leases, 800 million in debt, and then similar for the current portion. So this is not uncommon, because of course if somebody is going to open 10, 15, 20, 30 locations in a year, you're not going to buy 30 locations, then renovate them and all that stuff. So, and also capital leases, leasing location makes more sense if they open an unprofitable location, than to exit it. It's much easier, rather than if you buy a property, then you have to figure out how to sell it, and you might take a loss there as well, and there's taxes and all that other fun stuff. Aesthetics is a huge industry. I just don't know how many machines are needed to meet these demand. It's not just the machines, it's also the some supporting products related to them. It's definitely a huge industry. Have you considered Zillow? I have. It is part of my portfolio. That's also one of the companies that I'd like to add more to. The reports are pretty ugly, but the price is near bottom. Well, I think that the management historically has done quite a good job, with the exception of their idea of flipping houses, which turned out to be a poor decision. But other than that, they did quite a good job. But Zillow is, for example, one company where I hope that AI will benefit a lot. If, for example, they figure out a way to get into the whole transaction, basically capture a portion of the house transactions or the real estate transactions, even if that's like 0.5%, because now it's purely still like an advertisement to some extent, and subscription based model. So yeah, it's a very small portion, because I want to follow the company. I think that And then when it comes to Zillow, I think that they're the first ones, and then like as the saying goes, they're the first one, and then there's nobody, and then there's somebody way, way, way behind them. I hear so many CEOs who really need to read The Outsiders. Yeah, that's indeed the best book I know on corporate capital management. I'll definitely look into it. I mean, I have a couple of books on my list that I've ordered and are at home. So I really try to not order too many books, something that I have not been very successful at. So yeah, but it is definitely a book that I will buy at some point and go through. What's your opinion on Value Investors Club? I've heard a little bit about it. I'm not part of it. The thing is, I'm trying to avoid being part of large crowds and try to independently come to conclusions, and regardless of what the others say. And I think it's whether that is a Value Investors Club or any other community, it is good for having ideas, for hearing other opinions. That is all great, but it is important to step out of it and figure out whether you agree with that or not. And I see a lot of different communities out there that are being formed around a certain company, that they're just feeding one another with positive information, creating this vision that that particular company is dominant and is going to be in the period to come. And here's this article, and then here's this article, and if there's something negative, they basically overshadow it with positive information. And I don't want to be part of that kind of communities where just a certain company is being hyped. The thing is, I know that some of these individuals aren't even aware that that's going on. They're just thinking, oh, well, look at this, I'm right, and there's other people like me who also see this. And in some cases that is the case, but there are a lot of communities, and also I think around crypto, that behave in that way. My opinion is that Zillow is the best opportunity in the entire market. What is your favorite opportunity in the market right now? I don't think I can point to one that is the best opportunity. I'm not sure which one is, which is why I try to diversify into companies that I think have a good future ahead, and I hope that I'll be right on most. We've seen Deja Vu is an interesting but yeah, their growth is quite limited. I agree. I think that it is also a family-owned business. I don't expect huge growth ahead for sure. I reached out to them 2 days ago to the investor relations page. I just wanted to figure out, do they have any information on what the management is going to do when it comes to the excess cash? Because I don't want to spend too much time again on individual. Oh, by the way, maybe let's, before I move into that basic fit, yeah, the last thing that I mentioned is that the capital leases, that's very normal because they're going to lease most of the location. I would point out to the same things when it comes to the property, plant, and equipment. This is related to their equipment. So I would point out to this and figure out how is this changing over time. So the price of the PP per location. So basically my idea here is, can I figure out the profitability per location? How that changes over time? Is there a lot of fluctuation? Of course, the 2 years that I would exclude are 2020 and 2021 because those are COVID-related years, and naturally there's a lot of revenue decline and so on. So I wouldn't focus on those 2 years. But for example, if you take a look at 2014, 15, and then 17, 18, and then the last maybe 12 months, it already gives an indication of the trend and where the company has been moving towards. And then, for example, I also saw, I think there was some acquisitions. So here I would like to understand what are these acquisitions that are being done. So my process is really time consuming. I would really go into all of these annual reports. I would read what is going on. Did they overpay for these acquisitions? But also, does it make sense what they did, right? And same goes here. If they're paying down the debt, or are they issuing more? Are they buying back shares? Why? I want to understand, is this the the right approach, or at least the one that makes sense to me. Crypto is insanity. It's all hype and narratives, but I believe it has the best risk to reward. Yeah, sure, it could be. No, I'm not shorting any asset, whether that is a like equity related or crypto. I'm only going to bet on what I think it's it's going to turn well. Karnako, I hope that I'm pronouncing your name or your username correct. Hi, thank you for joining. Have you checked out Pool? It has a really good free cash flow. If I remember, it's about so I think I looked into Pool maybe, I don't know, a year ago or so. I think that in general, there is no doubt that the business is quite good. But that is why, and yeah, it has a good conversion to cash. The only thing that I didn't like is that it was quite expensive. So if you take a look at the, it's 13, 14 billion. If you add the debt to it, or the net debt, almost 15 billion. So the way I look at it is, if I buy the entire company, hypothetically, I would have to pay 15 billion, right? And what I'm getting for that is I'm getting a company that makes 700 million. That's before tax, right? Let's add the interest expense back. But basically, they're making half, maybe 600 billion. So I'm getting 600 million a year for paying 15 billion. And is it going to grow? For sure, but I would like to see a bit of a lower price for a company of this kind. But I think maybe the premium is deserved because it's a high quality business. So I've looked into it, but that was my rationale on why I didn't buy. Yeah, I mean, the price could be flat for, this is the 3 years, 5 years. It could be flat for a very long period of time, but I really need to see better. Well, the way I read it, so you're referring to the free cash flow as a percentage of the revenue. But when you're buying a company, you're not buying the revenue, right? You're not paying the revenue. You're paying the price. So if you take a look at the cash flow here, they have 9, 8, 9, 7, 8%, 10%, depending on the year. So they have a good conversion from revenue. After subtracting all the expenses, paying that down, they get a decent amount in cash. But if you want to buy the company, you have to pay whatever is the market price, and then you're getting a company that has that. So in this case, this is why I'm trying to compare. If I'm to buy the entire company without any debt, how much would I be paying for it? It's a simple exercise, and it's not one that it's definitely not the only one that I do, but it's a simple check to see if it's really, really, really overpriced, that I cannot justify any of that. Maybe Hermo. Let's take a look at Hermo. But again, I really don't. Hermo. Was this the one that you're referring to? Let me see yeah. Zinnenfabrik Bertolt Hermo. I don't know if I'm pronouncing that correct, but in any case. So let's take a look at what the company does first. $1 billion. So net debt position is, they have more cash than that. So now it's 900 million. Manufacture and sells milling machines worldwide. Provides a portfolio of machining Center C product series for use. Machine of Spartan helmets, car mirror, Francis turbine. Soft ice cream. It serves 5-axis technology, audio and consumer electronics. So they seem to be operating in quite a diverse, because it's still a kind of a machines manufacturing business, but still, if you take a look at all the industries, it seems quite a diverse one. So here, I would really like to understand the economics, the unit economics behind these machinery, or at least on average. So let's take a look at how the company developed over time. There seems to be a jump here, but it's kind of a recovery compared to pre-COVID. So like, first of all, one of the questions that I'd have here is, why was this impacted by COVID? Because they're developing machinery, so maybe the demand for their machinery decreased. But I just like to understand, what happened, like why? What are the types of equipment they're selling that was impacted by this? So they're making, I mean, pretty much, I'd say it's relatively stable, right? About 100 million operating income. There's these, not as much other expenses, relatively stable. Tax rate seems also, or at least the tax expense. So they're making about 70-80 million per year in net income. And so if I take a look at this, I wouldn't, maybe I can take one less year, so looks a bit more condensed, but I wouldn't expect that there is a lot of a significant increase in property, plant and equipment, because they didn't show a significant growth in the activity. So PP 60 to 79, relatively expected. Inventory, I wouldn't expect. So here, for example, there's from 63 to 110. But this would be interesting to understand. Is it, comparing to the cost of goods sold, is it much higher? Because it went from 66, which is not that far, considering that there was COVID and they were selling less, so they had still a lot of inventory, then to 83 and then to 108. So I would like to understand what happened here. Why do we have a higher inventory? Even though it is maybe a tiny portion of the balance sheet, it really could point out to certain challenges ahead. Then the rest, I mean, I can follow at least they don't have. If I take a look at, actually, they don't have debt. It's just that they have 170 million in cash. But if you take a look at their balance historically, they always had quite some cash, which is, there's nothing wrong with it. Maybe they just keep it in case something goes wrong. But considering that they have no debt, you can always borrow for a short-term emergency. But the thing is, they're earning. Let's take a look at the depreciation and the capex. So they're pretty much replacing the existing machinery that is used to manufacture the current ones. So probably they have 70-80 million in free cash flow on average. So basically 70-80 million, right? And I'll open a quick calculator, right? So let's say you buy the entire company debt free, you pay 80 million, or you get 80 million and every year, but what you pay for it is 903 million. So you get about 8-9% annual return on average. The thing is that this 100 million that's in between just stays there and it doesn't really create any value. But okay, it's not the biggest. So 8-9% is pretty much, in my opinion, the expected return on this company. But I would like to understand the business better before I add any assumptions in the model, because I don't see any estimates that probably because it's a European company, not a very large size, but I wouldn't expect any significant growth ahead of it. Only because, if you take a look at the last 5 years, it grew like 20%, 30%. So I don't expect significant growth. I didn't see anything too significant acquisition related. I don't see anything significant other than some dividends being paid. So this also to some extent shows that majority, so if you take a look at 70 million, 25, 45, so probably like 50% of what they earn, they pay out as dividends. Can I see the payout ratio? Is it close to 50%? Yeah, 60 to 45, 60 to 51. So it's a good estimate, but here you can already have an idea of what is going on with the company and what you can expect. So whatever they make, half of that or so, they'll pay to you as dividends, which would probably be, I mean, we can calculate that, right? So what is the dividend per share? 0.85. Oh, is that right? Payout ratio 51. There's also a special dividend. Okay, this one is running in between, because this dividend per share is just the regular one, and then they always have this special one. So it makes sense. I was like, what? That cannot be the case if they pay €1. So they're paying about, I don't know, 11 on 216. So it's like 4 or 5%, which is quite close to what I mentioned earlier. So maybe it is a better buy. Maybe. Did you check out Constellation software or Copart? Sorry if I asked too many questions. No, feel free to ask questions. I have looked, I think, into Constellation software only. Copart, I have briefly looked, but I didn't do too much research there. I mean, I can open it, but the thing with a company of this kind is there are a lot of moving pieces because it acquires a lot of businesses. So the way to value it is not just to value the state that it is today, but also to go back in time and see the acquisitions that the management did and what is the rationale there. And I've seen a lot of praise for the management. So overall, it business quality wise seems good. Pricing wise, I'm not so convinced. I'm not so convinced. I think it's moving into a price range where, you know, if you take a look at the share price, yeah, it went up a lot. I think it got really good sentiment, but I'm not sure if this is sustainable because, yeah, 30% per year, they're definitely not going to grow in the coming years. If you take a look at the revenue, see, they were growing at 15, 16, 20%, 30%. So you cannot expect that the share price grows faster than the company grows on its own. So, and, you know, profitability tripled in these 5, 6, 7 years, and the share price went up a lot more. But valuations wise, I think it was that was the conclusion that I got, that it is quite a bit overvalued. Copart I have not looked into. Karnako, I seen your last Reddit where you were asking for hints regarding yeah, so about Bawa, the only thing, Benjamin, thank you for joining. I hope that you enjoyed the stream and have a good night. Sleep well and you don't dream too much about finance. Maybe time for some rest. So when it comes to Alibaba, the company, valuing the company on its own is the easy part, right? The main risk there, it continues to be the environment in the form of, you know, I'm saying politics. And they have a power to influence the company to such an extent that the valuation, the range of valuation is so wide. And this is why it is trading at very low multiples or low valuation compared to what you would expect if a company of that kind is operating in the US, for example, or in Europe. So and that is really difficult to quantify, because how do you quantify what could go wrong, or how the company could be harmed by certain political decisions? And this is why a lot of investors stay away from a company of that kind, including myself, because I don't want to be exposed to that kind of risk unnecessarily. And there's always this so-called risk of delisting that potentially it could, because currently it is trading on a US exchange as well, but maybe if the relationship between the US and China deteriorates, maybe they will be delisted. And there are a lot of criteria around that. I think at the moment it's not so likely that happens, but still it is a risk that if anybody's investing in Alibaba is willing to take. Another UAE company that is quite cheap, Yalla. I haven't heard of that one, so it's really difficult to, I guess it's this one, Yalla Group Limited. And after this one, by the way, I'll call it a day or a night, because it's close to midnight here, and I try to I'll try to make more live streams if there's interest in that, but I think for today that would be more than enough. I try to host it in a time that is suitable for majority, considering that a lot are from the US. There's certain viewers from Europe as well, but yeah, it's it is getting quite late. So maybe this one would be the last one. I haven't heard of it, to be honest. So social networking and entertainment platform. Voice-centric group chat platform. And Yalalula, a casual gaming application. So would this be comparable to... I mean, I don't know if it would be a mix between social networking in the form of... It wouldn't be really WhatsApp. It would be more of these platforms where you can have group chats. But yeah, my approach here would be to really test these apps to see how they look from a user point of view, to understand the value that they're providing, and of course then it's more about the number of users and the monetization per user and how that changes over time. But it seems as they didn't start that long ago, right? What was do we have a year here? 2016. So it's not really that... Okay. So before that was another company. 2016. So that's not that far. That's not that long ago. They have some growth. They have acceptable margins. So for a company of this kind, probably the operating margins could increase to 30-35% because it's still software related. They don't really have a lot of heavy equipment. This is in US dollars, so we could say that they have about 100 million a year. Yeah, about 100 million or so in a year. I don't expect a heavy balance sheet. So yeah, so net property, plant and equipment, 5 million. That's it. So they don't really need to reinvest a lot in heavy stuff. So it's really scalable from that point of view. I mean, take a look at the balance sheet. If you take the cash out, they have like 50 million. So with 50 million in capital or so, they make 300 million in revenue and 100 million in profits. So it doesn't come as a surprise. Let's take a look at the valuation. So it's 800 million and they 300 million in enterprise value. So hypothetically, if you are to buy the entire company, you pay the 800 million, 880, you get 500 million in cash. So it's 300 million net, and you make 100 million every year. So based on this, it looks definitely undervalued, but what I would also look into is inflation over there and what would be a proper discount rate to ask for a company of this kind, because and I have actually, interestingly enough, maybe it's a good bridge for the last topic. There was this article that in Turkey, for example, the central bank increased the interest rates to 40%. So think about that the next time you read that the interest rates are up by 1% to, I don't know, 5-10%. But yeah, this is a very, very, very unusual environment. But you know, if something like this happens, this is why it's important to take a bit a broader view. Otherwise, if you have a company that earns a lot of money, but there's inflation of 30, 40, 50%, and it used to be much higher, by the way, the earnings aren't worth as much as you pay for them today. Yeah, you're welcome, Carnago. I'm glad that you enjoy the format, Martin. Thank you for joining. A mix of gaming, apps, and socials. Yeah, so they're waiting for acquisitions. Definitely. Rowan, thank you for joining. I hope that you enjoyed the live stream. So, mix of gaming apps and socials. I'd like to personally dive a bit more into details there, because it's different if those gaming apps are ones that are there to stay and there are certain upgrades that make them more interesting for the users, or if the company is dependent on introducing new gaming apps. So there are different approaches to that. So I'd like to understand that a bit better. And if they're waiting for acquisition, what kind of company would fit here? So I'm not sure if that is the right approach. Maybe the reason why they're under, at least based on the traditional metrics, what we see undervalued, is because there's some uncertainty that the acquisition will not fit well. Because imagine if they acquire a company that is that just doesn't integrate well, that doesn't create value, it's too risky. Basically, you would be paying for something that doesn't create value at all. So it's nothing is risk free, but I would like to understand more about the management. Do they have experience with transactions of this kind? If they have, you know, tens, 20, or let's say 10 acquisitions that really turned out well, then I have more confidence that if the management had no acquisitions prior. And yeah, the company itself, it doesn't seem that it has any acquisitions based on the balance sheet, so there is no goodwill. I expect that there is no acquisition being done. So far they haven't done anything. I'm wondering, this 500 million, was it earned over time, or was there also, yeah, so this is probably 2020, so I assume that in 2020 they became a public company, and this is some of the funds that they raised, because there's this additional, I mean, we can quickly check that, right? Yalla Group IPO. Let's see. Yeah, so they became public on 30th of September 2020. So actually, part of this 500 million that they have here is close to 200 million is raised when they became a public company, which is, I mean, there's nothing wrong with that, of course. But you know, before investing, I do want to have a bit of a better picture of where the company is headed. And there are a lot of companies that seemed really good on the surface, that where you could understand, like, yeah, of course, we all have social media profiles, so we know it is a social media platform, but is it a good one? Is it one that is easy to disrupt? Is it one that is temporary? Like, I know that I think Snapchat is one that just goes up and down. The users like it and dislike it, and that number fluctuates, and the share price follows that as well. So just because that, you know, I can understand the business, I need to really more deep dive more into understanding the consumer behavior, and that will help me make a better valuation ultimately. Turkey Different Times CEO owns 50%, if I recall right. Yeah, are you referring to Yalla? I'm not sure if, can I see that here? I guess that these two companies, or maybe it's the owner, Yang Tao, that owns 25% as the individual. And then there's Orchid Asia. Yeah, could be, definitely. Could be. High ownership is definitely good to see. I'm wondering if there was any big name that got a big chunk within the IPO. It's difficult to see here, but anyway, so this would be all regarding this first stream. It is close to 2 hours, definitely longer than I expected. We went through a lot of information. I hope that you found this valuable. I'll see how it goes when I can schedule the next one, if there's interest, if you enjoyed it. And I mean, if you have any questions or comments, you can always leave them below, and I'll take those into account for the next live stream, or maybe the next videos that are to come. I have a lot of ideas. I have a lot of, like, a huge list of maybe potential video ideas, but maybe ones that I'll cover in a live stream. And I think those are interesting to see, at least for those who are passionate on this kind of topics. Of course, it's not the most fun for many, but I enjoy it. I do enjoy looking into different companies. I do enjoy valuation. I do enjoy discussing a bit of macroeconomics as well. And I hope that you enjoy it too. Thank you very much. And as always, see you in the next one. I hope that you have a nice evening. Thank you for being supportive. Definitely a stream that I enjoyed. Take care.